Good morning, ladies and gentlemen. Just a quick brief word to tell you that the model is working again on wrist dials. We are at the moment just testing everything to make sure that it works, and within the next 2 or 3 weeks you'll all receive passwords so you can get in there and play with it. We've actually upgraded it a long way. There are now individual stocks for everything from the US to Europe to India to even Japan and China. So there is a lot more there and it works a lot better. We're just testing it at the moment, and you will all receive your password within the next 2 or 3 weeks. Basically, what we think is going on is that we are in risk on, and actually strong risk on. Let me remind you what risk on means. Risk on means that you have to prefer equities to bonds. And the model, I think, is perfectly correct. It is a period where probably nothing is going to perform very well, but I think what is going to perform least well is bonds. I have included in the summary sheet a link to this JPM study, which I actually tweeted to you on Friday. I think it's very important. And I think the one conclusion that is important is this one. The market is forward looking, and it is looking forward to the issuance in 2024. The last quarter of 2023 is going to be very heavy as well. I don't agree with some other conclusions that they have, mostly that the term premium is elevated because A, it's not, and B, they have never done comparisons, or we haven't had comparisons of what the long end of bonds does when we have such a steeply negative yield curve as we have at the moment, with QT on top. So some of the studies that you will read in this report, I think, are not entirely appropriate, and their conclusion is that the curve cannot steepen or bear steepen much more from these levels, I think, is incorrect. But what I think is correct, and what I think is important that you understand, is that the market is going to concentrate more and more on the enormous duration supply we're going to get in 2024 and in the last quarter of 2023. Okay, so let's have a look at what the individual tenures in the bond market are doing, and then the yield curve, and let's try to piece all this together. Now, I've told you for a couple of weeks that I believe that the very short end, everything from 1 month out to 2 years, is more or less stuck. The Fed has absolutely no hurry in it at the moment, and it has no reason to have any hurry to it. So what the market is going to be pricing in for the September hike is going to be basically from a zero probability of a hike out to a, I don't know, 30%, 40% probability of a hike. That keeps the 2 year within a tight range of 15 to 20 basis points max. So what do we see? We see basically a 2 year note that's going to be trading between 470 out to 490 odd. That is it. I really don't see that before the next NFP or before the next CPI, we are going to move outside of this range. So the short end, anything up to 2 years, I believe, is stuck in a 20 basis point range as the data comes out and the probabilities of a hike by the Fed change from zero. Good data will take you down to zero. Bad data will take you, up to 30, 40, even 50% of a hike. but the odds that we go to 100% hike are very, very low. It would have to be an extraordinary, very, very hot number that suggests reacceleration of inflation. I don't think we're going to get that. The inflation should not reaccelerate. It should prove sticky, but reacceleration, I think, is unlikely, and therefore I think that the two-year note, especially anything up to two-year note, is completely stuck. What potentially is not stuck is the very short end. This is the June 2024 against the June 2025 SOFR, and then also here the next one, which is the September against the September. So where is the curve going to pivot is the question. If the short end is stuck, as I've just told you, and if people start then thinking that cuts are going to get postponed, you will start getting a steepening of the yield curve at the longer end in 2025, because we will be there is absolutely no way that we are going to start pricing out the cuts in 2024. I don't think the market is going to do that, but I think what it's going to do is start pricing out the very steep cuts which are priced in to the 2025 area. So I think the 2024-2025 area can actually start to steepen back towards levels like this, like 97, from where we are. We have got the flattest levels in 2024-2025, and since we've had steepening in all the curves, it makes sense that now this steepens as a result of the steepening in the yield curve. Not huge amounts, but certainly, we'll put it on down here. Can it go to 97? Absolutely. Can even do a little bit better if there's some risk off, which we'll discuss later. So I think rather than playing 2s, 10s, 2s, 30s, which we will look at, this kind of spread in the 2024-2025 SOFRs is beginning to make more sense. Okay, then back to the individual tenures in the bond market. If 2s are stuck, 5s still have an upward tendency, but I really don't think that anything huge is going to happen in 5s. I certainly think this 449 area is going to hold it. The problem, I think, is going to be in the 10s and 30s. Let's have a look at what we've done all year in 10s and 30s. Okay, so we opened the year at 390 and we're now at 415. Hardly a huge amount of variation here. But if we start going back in time and change from dailies to monthlies, we will see that it's quite possible that this is going to be a 5-wave higher, with tops around this area here around 457. I still think the yield curve is going to steepen, and if we have a look at the 30s, we could easily see these levels around 470 as the highs. The issuance we're going to get is just humongous, and I think that there is absolutely no reason to step in front of it until you get the yield that you desire, and I think you will get the yield that you desire. If let's triangulate that with the yield curve. Okay, so if 2s are stuck, if 10s are going to be weak, you know that every time this comes back to around this kind of level, 83, 85, the odds are that it comes back down towards 47. So if you think that 2s are not going to be very far away from the 5% mark, that gives you a, 440, 450 10-year note quite easily with a little bit of steepening. If we look at 530s, again, every time it gets down up towards this 11, I think risk reward now says that it comes back down to minus 18. And if we look at 10s, 30s, I think that that says that every time we get to around this kind of level, minus 7, you are looking for levels down here around the minus 21. So to me, 10s and 30s are the ones that are in trouble. That's where people buy the duration, and people are going to be stepping back from buying the duration. So overall, from levels, I see a continuation of the bond steepening curve, an increase, a final increase, because let's face it, in the SOFRs, we haven't had any steepening in the 24-25 region. So that could be the last area that steepens. And then basically we will be stuck at higher yield levels. The market will have discounted all the issuance. And then I really don't see that we will be going much higher in yield, because I don't think there's any need for it. And also real rates will be quite high. That is what I see happening in the next couple of months, simply because we have, don't forget, we have the Fed meeting in wherever the hell they meet in Jackson Hole, and I can't imagine that they are going to be anything but consistent with what they have been saying, and that is that unless there are surprises in inflation, the cuts are going to happen probably mid to late 2024, and therefore all we have to look forward to until then is a continuation of duration issuance, which naturally should steepen the curve, because the very short end then becomes correctly priced, and the only pressure can come at the long end unless there is a risk-off event. That is very clear to me. Only a risk-off event can now prevent, from levels, the yield curve from steepening. This steepening bias is international. It's not just in the US. This is the two stands in Germany. As you can see, on Friday, it just fell apart. I don't think it goes a million miles. I think, we're very close to levels that are going to hold it for quite some time. But the this flattening trajectory that we saw in the first part of the year, I think it's over. I think anytime it rallies back to this kind of level, it's going to get sold again, and eventually we're going to end up down here, around this 20 area, or even a little bit lower. I think the flattening is over internationally. If we have a look even at Japan, the picture is clear. Everywhere you're getting some steepening, and I think that will continue because of the enormous duration supply that is in the pipeline. I think it's literally as simple as that. And since the duration supply is going to be mostly concentrated in the US, to me it makes sense that the 10-year US Germany keeps on moving out towards 172. I think if we now see these kind of levels around 143, 144, it's going to be a great risk-reward buy. I just can't see what happened, and we caught very well towards the end of last year, continuing, knowing what we know about the US supply. Also, don't forget that the economy in the EU is much weaker than the economy in the US. Really, it would make sense if this is some kind of a head and shoulders, and then we come back and retest the neckline, and then we go back up to 172. I think the risk reward of buying it at 142 or so is very, very good. The pressure should remain upwards, as it is in the twos. These are the twos in Germany, US against Germany. As you can see, the tendency is quite clear. Very clear, for the technicians. This is a inverse head and shoulders. We just bugger around here, and then we go back towards 230 or something like that. So to me, the steepening and the US underperformance in the bond markets should be the theme for Q4. Let's have a look at what I think in detail about the various tenures in Germany. I think much like in the US, the Schatz is completely stuck. I think the ECB is very much at the same point in time as the Fed. I think they're in no rush to hike again. In fact, they're praying that they get good data so they don't have to, much like the Fed. I think the probabilities of hikes are going to be between 0 and 30, 40, 50%, which gives us a range somewhere between here, we're talking 285, back up towards 330. So we are absolutely stuck in a 30, 40 basis point range, and that is where you need to trade. But if you have a look now at the bubble, that is completely stuck because the yield curve is pivoting around the 5-year area. So if 2s do better, 5s do nothing, and 10s do worse. And that is how the curve steepens. You can see that all the pressure is on the 10s, but I don't think it's going to be nearly as much pressure as on the US. So any kind of move back in the bunds, you are going to get this tendency to go up towards 289, 290. And I think that's going to be quite enough for the bunds, just like I think that 440 to 450 area is going to be quite enough for the 10-year. So could it be that we get something like 280 and then 450 in the 10-year note? Well, that gives us 170, right? So that gives us the tendency for the bunds to go up, but less so than the 10-year note in the US. Given my view as to what the interest rate differentials are going to do, it'll be no huge surprise to you that I just can't sell US dollars. I know that we are at the 200-day moving average very close, which is very steeply sloped downwards, and therefore it would be normal that if we break up, we get some kind of reaction back down towards this 101.92 level, and technically that is entirely possible. But I think selling dollars here is ridiculously bad risk reward given my view of the interest rate differentials. I think the euro is probably then stuck for the time being between the high 107s and the low 109s, 110s at best, and remains in this kind of range until we get a break of a sustained break of that 152 level in the differential between 10-year notes and the bunds, and we head up towards 170. When we do that, I think that we will easily break down towards 105. But that is for the medium term. At the moment, all I know is that I just can't sell I can't buy euros, I can't sell dollars unless it's at really good technical levels. Last week we got there, this 106.43. I actually missed it. Very good technical level, and then it just broke apart. It just shows you that the market is very conscious of the interest rate differentials and the direction of long duration in the US, and is very much afraid to be caught short dollars. I think that, that is a change in the market dynamics. The market is now afraid of being short dollars, and I think that you just cannot buy euros anywhere. But what I think you can do is probably keep on accumulating dollars every time it goes up towards the 110s. I really can't see much hope for the yen, because if the dollar is not going down but has got a tendency to do better, and the euro is relatively weak as a result against the dollar, but the euro yen is also in a bull phase, I really don't see how the yen can fail to get up towards the 150, even 155 area. And that is what is actually going to keep equities relatively bid, because, it's a funding currency, and we are seeing no signs of risk off as a result. To me, I know that it's very volatile, but euro yen has got the 160s, written all over it. I think any dip in euro yen is a buy for the longer term, and 160s, 170s are, it's the trend. It's where it's going. Gold, I think, is pointless trading it from a fundamental and also technical point of view, simply because the what it's saying effectively is that real interest rates are going to remain high for a decent period of time, which makes sense as people back off from buying duration, because there's no point catching the first bus. You might as well catch the bus that comes at the time that you want, i.e. at the yield you want. And if that yield is like, say, 450 in the 10-year, why buy gold? I mean, is there any point? Certainly not for the short term. It's not hedging anything. And therefore, to me, gold is just going to drift down and down and down. And that basically is what this behavior here has been saying to you. Real rates are going to remain high. No point in owning gold. Better to own, yielding assets. There isn't much risk off, so it's not hedging anything owning gold. As a result, I think slowly it can come back down to 1881 from, these are the futures, don't forget, from 1946, and whatever that makes, the spot. This, I reckon, will probably be enough for the time being, and it should, I hope, or even this kind of level, coincide with a 10-year note being at its extreme for this move. The market is always going to anticipate things, and it's always going to get to levels faster than you think is possible. So if in the next couple of weeks you see the 10-year note go towards 440, 450, and gold come down to this kind of level and fill this gap to 1850 or something like that, that will probably be it. That will probably be the move that has discounted just about everything there is known at the moment. DBC and oil, oil is God knows what percent, 60% of DBC or whatever it is basically teasing. I don't think you should do anything there. I know that a lot of hedge funds have bought commodities, but I think that was more of a mean reversion trade because they were down a lot compared to every other asset for the year. And I think now that they've achieved the, back to break even, I think slowly people are going to start selling their long positions. I This is what bothers me, the relationship against gold. I think it's unlikely to come down very much, and therefore DBC is unlikely to appreciate very much against gold. And the fact that I just can't see gold going anywhere but down or sideways tells me that the odds of buying DBC are not great. Okay, even if you look at things like copper, it's got this kind of level written all over it, this 3.5 level. I just don't see that there's any point in buying commodities at the moment. And even oil, I think, is now overbought. It's at the top of the weekly Bollingers. A move back down towards 75 is, you know, I don't think it's likely, but I think stopping people who just got long up here is more likely to be done than going straight up. I just can't see the pressure that is the economic pressure that's going to take oil straight up from here. A period of sideways trading, I think, is far more probable than straight up. Just not a buyer of commodities at the moment. I just don't see the logic in buying them. In terms of equities, I think they're stuck. I think that you're going to get relative rotation within equities, but I think against other assets, they're really not going to do very much at all. This is ITOT over government, so the totality of the stock market against the totality of the bond market. And I think that this is just corrective action. You saw that the risk dial is very positive, i.e. in risk on, and that it's saying that the primary trend of equities is higher, and especially against bonds, because don't forget it's an alternative indicator. So should you be in bonds or should you be in equities? And it's saying you should be in equities, and that makes sense. Now, can it come down a little bit more? Maybe, but I think it's very much stuck, and I think it's going to be trading around bonds. And if bonds do worse, as I expect them to do worse over the course of the next month or so, equities are basically going to be from stuck to slightly worse. And that is what you can expect. I just don't think that equities are going to make a major move down. For that, you will require data. And for the time being, I don't think we're going to get it. And that, to me, colors the perspective of what equities can do on the downside. I think the most relevant chart in equities at the moment is this one. This is the Dow over the NASDAQ. And I think that we are in a corrective phase where you should favor the Dow and the NASDAQ is the worst. Would it be surprising to come up here and fill this gap? No. I mean, look how far we came down, and look now where this gap is relative to where we have traded in the past. It's right where we have been trading for most of the beginning of 2022 on a relative basis between NASDAQ and Dow. Going back there and filling this gap really would not be surprising, right? Does it take a couple of weeks to do it? So what? So basically what the market is saying, trying to triangulate it all, is this. Duration supply is higher, yield curve is steepening. When that happens, the likelihood is that high beta stocks suffer far more than low beta stocks. Low beta stocks are in the Dow components, and high beta stocks are in the NASDAQ components. And therefore you get this relative move of correction of this huge move down that we've had between the Nasdaq and the Dow throughout the whole of beginning of 2023 on. So that is all you're looking for. You're looking for a corrective move to this huge move that we've had in 2023. And I think that filling this gap is likely, or more likely than not. And funnily enough, that is exactly what the market is doing. The Dow goes slightly higher. The Nasdaq does nothing to go down, and that gives the SPX stability. The SPX can't go anywhere because it's torn between the Dow components and the Nasdaq components, pulling in different directions. And so you see this kind of behavior, which is up, down, up, down, up, down, slightly down overall, but that's all it can be. Until and unless the Dow starts going down, the SPX can't really go down. It nearly filled this gap on Friday within a couple of ticks. Let's enlarge this and have a look. It was literally within a couple of ticks. So what? It's one of those. Can it then start, doing this, going back up, filling this gap up here, then coming down? Absolutely. I think the overall pattern for the next couple of weeks is unlikely to be up. It's more likely that we test these levels between 44.16 and 43.95, but it's going to be very sedate. Don't sell in the hole. There's no point. Your tell for when equities can go down will come from the Dow. It won't come from anything else. The Dow is the one that you have to look at, and only if it breaks these levels that I'll give you now can equities as a complex go down. So this is the Dow, and this is the level that I'm looking like a hawk and watching like a hawk to see if it closes below it. I will be a big buyer if we get there. Okay, for a bounce, I will be buying calls like they're going out of fashion. I don't think we can break it for the time being. Can we do an ABC down towards it and stay down there, a little bit, bugger some people about, stop them out. But I think it goes back up towards the highs at some stage. That colors my view for equities. They outperform or match perform bonds for a bit, and then at a later stage, when bonds have exhausted all they need to exhaust in terms of discounting where the duration can be taken down in the fourth quarter and in the first quarters of 2024, then we can get another period of outperformance of equities against bonds. That's the way I look at it at the moment, and I think this level of the Dow is going to give us very, very good clues for the next several weeks. And that's all really, in fairness, that we can look forward. After that, who knows what the data is going to be? Who knows what we could get from the Fed or not? Do we get a reacceleration? Of inflation? Do we not? So there's really no point in speculating past what is possible for the next couple of weeks. And to me, the tell is going to be 34,700 odd. Don't forget, this is DJI. If we can't close below it, or we get close to it and start bouncing, that's the low for equities for the time being. I think next week is going to be a very quiet week, a technical week, and really all you can do is wait for certain levels that give you very good risk reward. To me, certainly the best risk reward is to steepen the curve from levels. And if we get them, we'll certainly do it. Otherwise, we'll do nothing. When there is nothing to do, you do nothing. And that is basically it. I've included the link here for if you haven't read the JP Morgan piece. I think their targets are correct, but I think that their logic as to term premium and the fact that they've completely forgotten the negativity of the bond curve. So why buy it if you can wait? Makes a lot of sense, and therefore I just can't see anything else but steepening, and therefore a continuation of the Dow against the Nasdaq trade. Thank you very much indeed, and speak to you on Monday.